your loan to value and your interest rate. Your loan to value goes down and your interest rate goes up as soon as you're a first timer. You get 2 or 3 under your belt and all of a sudden you can start hitting max, and you're never going to get there until you swing the first hammer. So you just got to start doing it.
From cornfields to high rises, office to industrial, houses to hotels, and every other asset class in real estate, we cover the people, the projects, and the profit. Welcome to the Investing in Iowa show. This show is for go-doers, action takers, and business owners. It's for people like you who are sick of Uncle Sam taking a huge bite of your apple. If you're looking to get ahead of what's taking place in Iowa, learn who is doing what, and how you can get in on the action, you're in the right place. Hosted by Neil Timmins, an Iowa native who has been involved in over $300 million in real estate right here in Iowa. Recording in studio from West Des Moines. Here's your host, Neil Timmins.
I've got Dave Lewis here on the show. Dave, welcome.
Thank you for having me, Neil.
I'm excited you're here. Say for the audience to say, who are you? Where are you from? What do you do?
Sure. So my name's Dave Lewis. I work for Halo Capital. I am a mortgage loan originator for about 20 years. Where I'm from, I grew up in DeSoto, Adel area. Yeah. Made it all the way over to Urbandale. Really big trip. Been in Urbandale ever since I was about 20 years old. Same time I got in the mortgage business. Yeah. So
how'd you stumble into the mortgage business?
So at the time I was in college, and we had another gentleman and I had someone approach us about doing mortgages and how much money you can make. And he's exactly the guy off of the movie, The Big Short. It's just greeny, gross. You don't want to deal with him. We didn't know that at the time. We got in there, realized what was going on, made some money, but realized what was going on and got out of there and got to a more reputable spot. Okay. That's what got me in the business. It was just that greasy, grimy, go make money mentality.
What year was that?
2004.
All right. So things were on the uptick. That was the year I started in real estate.
Okay.
Things were getting really good.
So I tell people, like, well, what'd you do in 08 and 09? I'm like, you got to remember, I was 20 at the time in 04. So 08 and 09, I was 24. I was more worried about like other things at that period in my life and not so much real estate and what was going on. Yeah. I also tell people, I think it was a blessing because so many people who were successful in 04, 05, 06, when 07 and 08 came around, they were confused. They didn't know what to do with themselves. Yeah. They were lost. Whereas I was like, I don't know. I just head down and business as usual for me.
A lot of those people found new professions.
They did. And we've seen that happen again the last few years, and we're seeing it happen right now. It's the same thing. When it's easy, we have this influx of people, real estate side, mortgage side, whatever. Yeah. When it gets hard, those people get weeded out pretty fast.
I've always said, I bet you could probably track the number of agents, I suspect you're worldwide, the number of mortgage brokers, industry to its peak.
Yes.
And then identify, all right, when we get to cross a certain threshold, you better be mindful of what's coming next.
So we were just in a class, and Craig Christensen was there, who's the guy that runs the division of banking. And now they call it something else under some other silo or whatever of the government. But our peak was like 14,000 loan officers in the state of Iowa. A lot of those are Quicken and Wells Fargo call center people. Yeah. We're down to like 6,000.
Wow.
Like 40% of the peak just in 2-3 years, not like 20 years ago, like 2 years ago.
Yeah.
It's pretty wild.
What are some of the biggest changes that you've seen over the course of your career as it relates to financing?
Well, I mean, Dodd-Frank was obviously huge and the rollout of that. The biggest thing that I think I've seen last was the CD requirements or closing disclosure requirements for primary residence and the timing of that. Yep. And real estate agents being confused about when a seller has to see one versus a buyer and all of how that shakes out. In the first few years I was out there, closings missed because they didn't get sent out at the right time or they weren't disclosed properly. That's kind of ironed itself out. But for a couple of years, that was rough.
Yeah.
That was really rough. And we're starting to see that now a little bit with the real estate commission. There's no consistency to it. I mean, the change isn't monumental in my opinion, especially if you're in the commercial space. We've always negotiated commission in the commercial space. So it's kind of business as usual, really, from my perspective. But from the agent's perspective and the paperwork they have to do, it's different.
Yes.
And it's not consistent. And the verbiage isn't consistent. And so that gets a little bit confusing right now. And what I have to count and not count. And agent pushback, like, we'll have to ask agents, how is this deal being compensated? We have to know. We do have to know because if a client agrees to pay their own buyer side commission, we have to source that now. So my cash to close number, if it's financed in the deal, maybe let's made up math, $10,000, right?
Yep.
If there's a buyer commission in there, the buyer agreed to pay $5,000. Yeah. I have to source $15,000 as part of the transaction. So we have to know that information, and we get pushback and people yelling at us, telling us we don't need it. It's like, we don't actually care. We have to do our job though. So we have to show it. It's interesting.
Yeah. Well, that's incredible. If it's POC, right? Paid outside of closing, you still have to prove that they have the funds to do it.
Right. It's still part of the real estate transaction.
Correct.
You still have it on a real estate document.
That's right.
So we still have to know about it because we're facilitating that transaction.
Yep.
And if you actually paid commission truly outside of closing, that's not legal from Fannie, Freddie, FHA. All that money has to be sourced and shown on a closing.
And disclosed to the lender, Chris. Otherwise,
and it has to be disclosed to the buyer. Like everything has to be disclosed. Otherwise, it's not technically legal. So that's why we care. Okay.
Yeah, that is interesting. One of the things that I find interesting about you is you run the gamut relative to what it is that you finance.
Yeah.
What you do. A lot of people end up doing one thing and just doing one thing forever. You seem to have some varied interests, and that probably opens up the ability to converse, have conversations, think about, and help a multitude of people.
Yeah. So we're talking a little bit before we started this about, so when I started in the business, it was just primary residence, traditional mortgage lender, helping people. But I myself got into doing investment properties, saw what banks do and don't do, realized there's opportunities in the marketplace of what can be done, and trying to get all of that molded into one big happy, I'm using my hands, you can't see this, but all one big happy hug or circle. So at Halo Capital, we do run from small private money of like $3,000, $4,000 payday loans, kind of for employers that are self-employed looking to fund payroll that week, all the way up to multi-million-dollar, commercial properties and anything in between.
Yeah. One of the things I think has been one of the largest changes in relation to single family investments is the creation and the usage, I say widespread across the country, maybe not necessarily here in the backyard, but DSCR loans, right? Relates to single family. Maybe for the audience's sake, if they don't know, if they've never heard of DSCR, what does it mean? And then, what is a DSCR loan as it relates to single family property?
Yeah. So DSCR is just debt service coverage ratio. So essentially what you're doing is you're using the debt, in this case, the house or the apartment complex, the income that unit can generate, will it cover the mortgage payment? That's it in a nutshell. That's as basic as it gets. That's what we were talking about. And what happens is banks start to have their own rules and policies around how they want to implement that and what they count for the debt that you have to qualify with, what they'll use for the income that you want to count. And so we have to look at it depending on what type. Single family is different. So back up. So 1 to 4 unit single family on debt service is pretty straightforward. You have $1,000 a month in rent. We need to keep your payment ideally in that scenario at $1,000 or less.
1 to 1.
1 to 1. We can do that all day. The magic number is 1.25 or higher. That's the gold star. You don't have to be at the gold star, but that's the gold star. So that would be round math, a rent of $1,250 and a mortgage payment of $1,000.
The benefit of that being the gold stars, I suspect what I hear you saying or reading between the lines is you probably get better debt pricing.
Correct. You get higher loan to values and you get higher or lower rates.
Yep. Okay. Yeah. And single family homes.
Yeah.
The benefit of this is you can get a 30-year fixed rate.
That's the other part of this. So this style of loan where you're comparing the rents to the payment is very similar to commercial financing in general.
Correct.
The difference is going to be that we're not doing it on a 5-year balloon or ARM with a 20 or 25-year amortization. This is a true 30-year fixed, amortized over 30 years. So now what you're qualifying for, again, that payment is going to be lower than what a bank would use for a payment. So you don't have to have the same math to make the deal work.
We just priced we're working on a pretty significant refinance on a commercial property, and it just, we're interacting with a handful of banks. But I just had a bank yesterday. This is an absolute net deal, so I'll explain that. But I'm going to tie this back. So you're good. To the point I want to make here. Absolute net deal means the tenant's responsible for everything.
Right.
Taxes, insurance, the roof breaks, the parking lot breaks. It does not matter. They're responsible for all of it. So the bank sent us their underwriting, and they, off the top of the rent, they hit us for 5% vacancy. They hit us for 3% in replacement reserves, and they hit us for 4% on management. And my argument to them, of course, we have almost a decade left on our leases. There is no management. They pay everything. Literally, a check, ACH comes in once a month. There is no interaction with them. I mean, there's no management, but we take it, add those 3 up. It's a 12% haircut off of rent,
right?
Before we can then go price. That's our new number.
Yes.
And what I hear you saying is you're not taking a haircut off that rent number.
So uniquely, as you mentioned, we have a big gamut. So I have a couple of local banks that I partner with as well.
Yeah.
I don't work at a bank, so I don't know everything that they do, but I'm familiar with their product pretty well. If you're going to offer it.
Yeah.
So yes, they typically, depending on the bank, will have a vacancy rate, a maintenance rate, a property management rate, and some other stuff baked in it as a bird flies rate of something.
Yeah.
And it's somewhere between 8 to 15% they usually take off the top.
Yeah.
For anything that I do on the secondary market, there's none of that. It is face value.
Right.
So now we're comparing apples and oranges a little bit in a good way.
Yep.
Because we're taking face value for a 30-year versus a haircut over 20 or 25 years.
One thing that I find interesting is you say it's the secondary market. You're underwriting this to a standard in which ultimately is going to trade on Wall Street because they're going to package these things in a bond.
Hey, Iowa investors, this is Ava Baukamp, Chief of Staff at Legacy Impact Investors. Have you thought about adding real estate to your portfolio but don't have the time or desire to play landlord? At Legacy Impact Investors, we do the heavy lifting. Our team finds the deals, manages the properties, and handles all the day-to-day operations. Our select group of qualified investors co-invest with us, gaining ownership equity without opening a tenant email or responding to a maintenance call. They just share in the income, appreciation, and tax benefits. These opportunities aren't for everyone. They are for qualified, accredited investors only. If you want to learn more, please visit legacyimpactinvestors.com to apply.
So that's the question I get a lot. Well, who's buying these things? And who's buying them is mutual funds and insurance companies. That's who's buying them. They have to invest in something. They can't invest in the stock market. So they're investing in a tangible asset. We're packaging these together. They're not insured by the government. So they're not taking a bunch of money off the top, which if people don't know, that's what they do on standard FHA conventional deals. The government takes some of the money before the investor gets it. This is all just investor money. Just whatever they want to do. So like, well, we'll do it. I don't know. We'll have to find out because every investor has different rules around certain little things.
Yeah.
And that's what's unique to us. So we have about 30 investors that we work with. I mentioned like 12 of those are straight commercial.
Yeah.
But every one of those has a little different rules. Good example, I had a property where it was a 6-unit and one of the overall square footage worked, the numbers worked and all them, it mathed just fine. Yeah. But the investor had a policy that no individual unit could be below 500 square feet. So when we got the appraisal back, one of the units was 450.
Yeah.
So that investor, that squashed the deal. They wouldn't do it. That's just their rule. Couldn't get around it. At another investor, the average square foot has to be over 500 square feet. So I could move that to that investor, knowing that now they had a different policy. So same concept, but a little bit different in how it's underwritten. So we can kind of nuance in and out of those as necessary based on the property.
Yeah. When you say investor, it's largely a big financial institution that's behind you that has an underwriting standard, funds the deal, does everything, and then ultimately they package it up and sell it to somebody else.
Correct. Who services it and usually droves of 100 units or what have you. Yeah.
As a result of having, back to the single family side, I would imagine most of those, what you call investors behind you, you can play stuff with. Most of those people probably have very similar standards. Is that fair to say?
No.
They're all over the board.
I would say of the standards that we have to meet, 70 to 80% of them are similar.
Okay.
But I would say there's probably a good 20 to 30% that are investor specific, be it loan amount, be it property type, be it, again, that square footage thing, just little nuances like that. There's more differences than you would think.
Yeah. Can you give me an example? I mean, can people cash out, do a refinance if they've got a same deal like this? Can they package property together and do more than one at one time?
And so some of our investors will allow you to do cash out with this debt service coverage if you've got leases in place up to about 75% of the property's value.
All right.
And you can package if you want to. You can do those individually. So if you had 10 properties, you could do 10 independent loans, all at 75%, go from there. Yeah. We have some investors that will package them together in either pools of $1 million up to like 10 or 12 units, individual homes, and just do one loan against all of them. So yeah, we could do 10, 12 units or single family homes, 75% cash out, get copies of 12 leases, get 12 appraisals, but it's one loan, poof, away you go.
Probably see some fees as a result of that.
Yeah. So the last one we're working on, say about $1,500 a house in fees. So it'll cost 12 units or 10 units in that case. Yeah. $15,000, $20,000 you'd save by packaging that together. And then you've got one payment, especially if you're managing your own portfolio.
Sure.
Now you've got a few less things to check on every month as you're writing checks.
Yeah.
Try to simplify it.
That you've got confidence to know that you have a fixed rate for 30 years.
And that's on a fixed rate for 30 years. Yeah. So that's the other piece of that puzzle is in theory, if you go to a bank and get a 5-year balloon, in 5 years, they're going to come back to you and say, oh, you're still good, and redo it. And it'll be pretty simple. But if your credit's gone down, or you've got a job loss, or the tenant trashed the house and you're in a limbo spot, you're in a pretty tough spot with the bank at that point.
Yeah. Or if interest rates go up.
Yeah. And then there's that piece of the puzzle. So if we go back to what the 80s and they're at 13, 14%, you don't have to worry about it.
Right.
They do have prepayment penalties. We can waive them. Again, there's a fee.
Yep.
Usually a short period, 1 to 3 years.
No.
We can go 5.
Yeah.
On the rate's cheaper on a 5.
Yeah.
But you can sell them off individually at that case. There's a little bit of a penalty, but you can sell them off, but you don't have to refi. You can though. So if rates go down, back down, the Fed goes back to 0, which I doubt ever, but maybe,
right.
Then you could refi them the whole package again, or I could refinance the whole package again. If rates drop to 5s instead of 7s and 8s where they're at, if they drop to 5s, sure, let's refi.
What kind of properties are you investing in? And I'm wondering at the same time, how are you utilizing your skills and your expertise on the finance side, kind of put a package together for yourself?
Yeah. So I've been doing mortgages about 20 years. So about 8 years ago, me and my business partner on the real estate side, not the mortgage side, we're like, hey, we should buy a house. He used to do construction. I'm like, sure, I've got some cash burning a hole in my pocket. I guess let's figure it out.
Yeah.
So we bought our first house and just kind of winged it. Honestly, we didn't really know what we were doing. I'm sure if you calculated our hours spent for how much money we make, it's a really scary number, how low it is. But from there, I got onto bigger pockets and started listening to different things. It's kind of got that itch and kind of researched more the BRRRR method, really.
Yeah.
And, nowadays we've got 10 doors, all BRRRR method.
Yeah.
We've got other flips in there that didn't work for the BRRRR, that just worked as a flip.
Sure.
That we've done as well on top of that. But we've got 10 in the last few years that at this point on paper, I have zero money into them. I have several $100,000 in equity and we cash flow several $1,000s a month. I had money in the transactions along the way.
Yep.
In my business, we had money into them, but we've got it all back out and then some.
Yeah.
And we still have hundreds of thousands of dollars in equity and cash flow thousands of dollars a month.
That's incredible. What are some of the lessons you learned along the way on that side? In the real estate business that took you probably from the first transaction to success?
Yeah. We all think we can do it cheaper ourselves, right? Oh, I can get that done. Oh, I can do that. No, you can't. And maybe I shouldn't say that. You can maybe, but you really have to start. There's books and all things you can read about, if your hourly rate that you normally get paid is $40 an hour, but if it's like 100 or 200 or 300 bucks an hour, it's pretty hard to justify spending your time sanding drywall when you normally don't make $20 an hour. It's pretty hard to justify that on a Saturday away from your family. In my mind, everyone's different.
Yeah.
So obviously that's the biggest thing, is being quick to allow other people in that space to do their job. We save more money by letting someone who is a drywaller do it because of the time and the overhead of carrying costs, right? So we come to you or someone like that for hard money, right? So on some of these deals, we do hard money up front.
Yep.
I can get money sometimes secondary market. Quick, easier sometimes works better. So we use hard money as well. If we have carrying costs and you think, oh, I can save $2,000 or $3,000 by drywalling this or putting in this flooring or having my brother Bob fix that plumbing issue, but it costs you an extra 30 days of carrying costs. Did you really save any money?
Right.
And usually the answer is no.
Correct.
So that's the biggest thing, is just that and just not being scared.
Speed does matter a lot. You said that oftentimes you can do it cheaper. We've flipped hundreds over the years.
Yeah.
If I spend too long inside of a house with the guys talking about whatever, they literally
Time to get out.
time for you to go.
They know. I just know.
They know. I don't own a hammer. I always said if my wife ever left me, I'd own 50% of her tools.
Yeah.
I'm skillless in that regard. We all have been blessed in one way or another. Know thy strength.
Yeah. Well, and I grew up, my dad did construction growing up.
Yeah.
And so I know how to hang drywall.
Yeah.
I have tools. My hands are soft though. And I wear gloves when I swing a hammer, just so everyone on this podcast knows the reality. But I just don't do it. I let those guys do it. Get with the right people.
Yeah.
The other thing that I think I've learned, and I tried to talk about in some of the other groups we're in, is you gain so much knowledge and are exposed to so many more opportunities just by doing it.
Sure.
That's probably the biggest insight I've gained. Literally this morning.
Doing it meaning taking action.
Yeah. So literally this morning, I drove by a house I'm currently flipping.
Yeah.
And I was in there looking at the drywallers who were going too slow for me. And I was there and my general showed up and we were talking and he's like, oh, hey, I got a lead on this house. I don't think I can buy it. Do you want to go look at it? I'm like, maybe. He said, no, like right now. They want to sell it. It's from a guy that lives in Tennessee. He doesn't want it anymore. He wants to do seller financing. Yeah. I'm like, I'm in. Let's go. Yeah. So I picked up a house this morning by literally going and looking at drywall on another house just because I was there and checking on something.
It's unbelievable. Opportunities, just taking action creates more opportunities.
It does.
We've had ones like that where the neighbor will buy a house and they're working on it and the neighbor will come over and go, do you want to buy mine too?
Yeah. So we call that, so way back in the day, I used to sell windows and siding for a hot minute, which is wild. And it's a story for another time, but we used to call it teeing up the lead, right? So you go to a house that needs a roof, but you look at both neighbors and across the street.
Yep.
That's the tee. So I do that now when I go look at properties. Yeah. I tee it up. I knock on all the doors. I talk to all the neighbors. I give them my business card, let them know if they see shenanigans or know anything to call me. Yeah. But I also am like, hey, we buy houses cash. Have you ever thought about, if it looks a little rough, have you ever thought about selling your house? You'd be amazed the conversations, not me, but my sister or whatever. I'd be amazed the conversations, just knocking on some doors. Yeah. You're going to be there anyways. You have a valid reason to knock on the door and just give them a heads up. Right. Hey, there's going to be a bunch of dudes in trucks coming up that you may not know who they are. Yeah. If they're causing problems, call me.
Most of the time, you got a friendly neighbor and somebody, sooner or later, you hit that neighbor who watches the whole neighborhood, who knows everything.
Oh, dude, we get those calls all the time.
Sure.
Hey, Tim was over there today. Yep. Hey, thanks. Maybe I was calling, give you an update about who was there. Yeah. It's crazy how much that stuff just creates opportunity. So really trusting the professionals, and analogies that I use a lot that I read in a book, correction, I listened to in a book. Yeah. You can read about swimming, but until you're actually in the water, doesn't matter. Yeah. And it's the same thing with real estate investing. I know a lot of people like to read about it, and it's great to get your general knowledge, but you really just need to do it. Yeah. And get some advice from some people who can help you, but get your first deal under your belt. Because even with some of the financing types we're talking about, one of the first questions that I have to answer is, what's your experience? So we can also do fix and flip loans. Yep. Just like your hard money, right? Yep. So the first question on that questionnaire is, what's your experience? Right. And your loan to value and your interest rate, your loan to value goes down and your interest rate goes up as soon as you're a first timer. You get 2 or 3 under your belt and all of a sudden you can start hitting maxes, and you're never going to get there until you swing the first hand. So you just got to start doing it.
What's your goal in your rental portfolio? Well, I'll set it up this way. Interest rates have moved pretty heavy over the last 24 months. Tell me more. And so I'm curious about how that's impacted your BRRRR methodology and then what the goal is moving on a forward basis utilizing the BRRRR methodology.
If you're a house flipper, execute the BRRRR strategy or do double closings and are in need of money, Little Guy Loans is your go-to lender here in the Des Moines area. Time is money. Loan approvals in 24 hours. Closings in 5 days. Little Guy Loans was founded by Neil Timmins, an investor just like you. Since he has been in over 10,000 homes in Des Moines, there's never an appraisal. Houses, multifamily, and commercial property loans up to $1 million. Check out www.littleguyloans.com.
So the only thing that it's impacted for me would be, well, 2 things. One, rents have gone up in the last 2 years at the same time that rates have gone up. So I would say proportionately, it hasn't really changed much on paper. A little bit. It has papered out a little bit tighter. Yeah. But I do 2 numbers. So I do my BRRRR method right now. Am I making enough money to meet my debt service coverage to do a refi and get out of a hard money or a construction loan? Yep. Can I meet that criteria? And then what does my math look like in 5 years? What I mean by that is if I can refi to a 5 or a 6 versus a 7 or an 8. Yep. That plays into if I'm waffling on a property we recently bought right now isn't a home run. It worked. It BRRR'd. We broke even. We're making about $100 a month on it. Yep. It's rented. It's not a great deal. We didn't lose any money on it, but I know that when rates go to 5 or 6, now it's cash flowing $300 or $400 a month. Yeah. So that deal was a good example of where I'm looking at rates. Does it cash flow today? Am I losing money? No. Is it a home run? No. Will it be a home run when rates drop? Yes. But I'm going to buy it today because when rates drop, it's going to cost more to buy it. And that's the other part of this puzzle that we haven't talked about, that it's huge, that people are missing, I think.
But what's not going into your analysis, because you don't play that game, is the appreciation factor.
Correct. But I think that what's unique about that here, and where I caution people when I talk to them, is feel free to Google whatever you want, right? Look it up, or TikTok. I guess Googling isn't a phrase for these young kids these days. If you want to TikTok it or whatever, the problem is they don't take into account what happens in Iowa. So they talk about these wild swings we see in like Arizona, Las Vegas, California, New York. We don't get those here, right? In 07 and 08, on average, the appreciation in Iowa was negative 0.1. So I'm not saying that there's not people, you don't know Tom's sister's friend, Sally, who had a house, who bought it for too much and didn't make any money. Yep. That happened. But as a group in the state of Iowa, even in the worst like bubble that we had in real estate, Iowa on average, negative 0.1. That's not I can send an article whoever wants it from the state of Iowa. Yeah. So we tend to average around 4 to 5% appreciation. Last year was over 5. Yeah. So these houses at 200,000, not only if you don't buy them today at 7% rate, let's just use that as a benchmark, as a watermark, The house is 200,000 today at 7%. I'm not sure I want to buy it. Well, I'm going to tell you in 2 to 3 years, when it's 240 at 5%, it's not going to make any better math on paper.
Correct. Yeah. That's also 5% unlevered.
Yes.
So as soon as you start adding in, you've got a 70% or 80% loan to value.
Right.
The equity multiplier as a result of that appreciation
Are massive.
Correct.
It's huge. And so that's where I think, so we don't typically use that. So when you Google or look up, how do I calculate NOI? How do I look up DSCR? How do I calculate, I just forgot a term, cap rate. Sorry, there we go. If you want to do it by the book, you don't take that into account. I do in my personal stuff because I feel comfortable with what I know, what I've seen happen, and know that, okay, if I can buy this at this number while I'm not making a bunch of money monthly on it, maybe right now, I've got this gain coming.
Yeah.
In bigger picture in Iowa, one of the fastest growing states, the Midwest in general, if you look at an appreciation schedule for projections, it's one of the highest. They're saying the coasts are already pulling back. Rents are coming down on multifamily. They're going up on single family nationally.
Yeah.
Even more so here from what I see personally. So I do take that stuff into consideration when I look at buying stuff for myself or when I talk to investors.
Yeah.
Just about what works. Now, you still have to make it work on paper today to get the deal done.
Yeah.
But if it's tight, I don't feel as concerned because I feel like the market's in a good spot for future growth, I should say.
Yeah. The goal there is, or the hope is, we have tremendous growth that's actually real.
Yeah.
Supply and demand, the largest things that are going to move pricing, simply a factor of supply and demand.
Right.
We have job growth and population growth.
Yeah.
We're headed one direction as it appears, and it's been the fastest growing. Des Moines, the MSA has been the fastest growing city in the Midwest for multiple years now.
Yeah. And if you look at a general population, so we've got a couple of things in housing that are interesting. So you've got boomers who have nowhere to go. What I mean by, and this is a bigger housing conversation, I guess, for this, but they have nowhere to go. So the retirement communities and the long-term care facilities, people have a stigmatism of nursing homes from the 70s and 80s, and probably rightly so. I remember my grandma being in one and it was awful.
Right.
And so they don't want to go anywhere. So they're holding on to their houses, which is creating supply.
Right.
At the same time, we have the next largest population in the US turning somewhere between the ages of 25 and 33. Well, the average first-time home buyer is 33 and a half historically. So you have this swath of population coming into a market. Boomers aren't selling. You have people coming that need to buy. We're already a housing shortage.
Correct.
It's not. And they're talking about trying to grow the US in general, right, because we're actually have a population increase.
Correct.
Without immigration, which getting into that. But from a population standpoint, we're trying to grow. We don't have enough housing. So that's going to supply and demand on all fronts, whether it be retirement, young kids, Iowa, blah, 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 blah. It's all going to push housing pricing higher.
Shy of significant government intervention, i.e. them literally handing out tons and tons of money.
Yes.
Affordable housing cannot be created. Only creation option is an apartment.
Correct.
Or condo.
Yes.
Right. So
yes.
Some sort of highly concentrated. That's the only way you're going to get costs under control. And there's only so much of a segment of a population who will accept that as the option.
And then as you know, and that's a harder market to make money in because they tell you what bucket you can make certain money in. It's not an aggregate. It's all this spot, that spot. And it's a lot of paperwork to make a little bit of money.
Okay.
I don't know. It's going to be tough.
Yeah.
It's going to be tough.
It's going to be interesting. What are you most excited about for 2025?
What we're talking about right now.
Yeah.
I think the opportunity. So two things. As investors listening to this, you have to remember during COVID, there was a forbearance that happened for house payments, and you couldn't foreclose. So in certain states, certain rules are different, but basically properties, if you look it up, foreclosure rates are at an all-time low and everyone's talking about it. Politicians are talking about it. Housing in Iowa was talking about it, but it's low because they couldn't physically foreclose. Mm-hmm. The number of buyer brokers' opinions that are being done by banks on houses that are being foreclosed on right now is a lot. There are foreclosure inventory coming. It just hasn't hit the market yet because we haven't been they couldn't start foreclosing until the beginning of this year of 24. Normal foreclosure process in Iowa, the fastest you can physically go is 6 months, really. Well, that's not true, but basically, if anyone wants to fact check this, go for it. Yep. I'm talking roundabouts and issues. Yeah. But it's like 6 months about as fast as you can go to a year.
Yeah, and if you got a good attorney, it being foreclosed on, it's probably closer to 2 years.
To 2 years, right. So we're only at 10 months
right
into a cycle of being able to foreclose. And those places are overwhelmed with that paperwork.
Mm-hmm.
So that stuff's coming in 2025. I do think rates come down in 2025. We're not going back to 3% and 4% rates, but they will come back down. I think there's going to be a lot of good opportunity in the next couple of years. A huge opportunity.
You could do what you do anywhere. What keeps you here? Why Iowa?
Well, I grew up here, obviously. I visited a lot of places. I say Iowa is a great place to call home. Yeah. I've yet to be to too many places where I could see myself raising a family there. We still have Iowa Nice. People still open the door for you. They still say good morning. People genuinely actually care about each other here.
Yeah.
Typically.
Yeah.
You don't get that in a lot of places. From that perspective, I like it.
Dave, you ready for the final 3 questions?
Oh, jeepers.
Here we go. One piece of advice you would give your 20-year-old self.
Meet more people, take more risks.
2 books that changed your life.
Napoleon Hill, Think and Grow Rich, and a second book. Oh, you know what? Most recent book, and I've read it multiple times, is Green Lights by Matthew McConaughey. If you have not listened to him read it, you have to. It's fantastic.
Yeah. If you were cast away on an island for a year, you can only get 3 pieces of data about your business each and every month. I'll let you define your business however you want to. 3 pieces of data about your business each and every month. What 3 things must you know?
For my job to do it?
Job or the real estate side? You pick however you want to answer that question.
That's a tough question, actually. 3 pieces of data I need to know in order to do my job. Where mortgage rates are, my cell phone number, and now I'm getting a piece of paper so I can do some math. The things that I need to know. If anyone who knows me knows, I've always got a notebook and a sheet of paper somewhere and I'm mathing something out.
Yeah. I've asked lots of questions. What's one question I did not ask that I should have asked?
I mean, I guess use you and use me if you're looking to do, anything in real estate. Leverage the people you know or don't know. Reach out, ask questions.
It's a collaborative community, is it not? And you and I are in multiple groups that we overlap with each other. And
I'm honored to even be included in this podcast or any of this. So some of the names you've had on here are pretty amazing people.
Well, we're adding Dave Lewis to the list.
No, I'm mixing I am, but
for people, they want to find you, they want to follow you, they want to connect with you. Where can they go? What should they do?
Yeah, I would say so. I'm not a big social media guy. I'm a little older school like that. So my phone number, you can call me, email me, text me. I'm Dave Lewis with Halo Capital. My email is dave@sayhalo. My phone's 515-321-5913. Text me, spin smoke signals, do whatever you got to do. But I'd love a conversation or a coffee.
The details are below in the show notes. Everybody, Dave, I appreciate you being here.
Thanks, sir.
Thanks for listening. If you're enjoying the show, may I ask a favor of you? Naturally, subscribe so you never miss an episode. But would you rate and leave an honest written review on Apple Podcasts? It does a lot for us here at the show, and I appreciate reading your thoughts. Great guests make for a great show. If you know of another Iowan who would be a great guest, or you yourself have interest in being a guest, well, get on our radar. Visit Investing in Iowa to fill out an application or recommend a guest. And if you want to connect with me one-on-one, go to LegacyImpactInvestors.com. Click on the Invest With Us button in the top right corner, and there you can pick a time for the 2 of us to get on the calendar and connect. Until next time, keep investing in Iowa.